All right. How's everybody doing? Good evening. How's everybody doing? Tell me where you're from. Type in the chat pane. Go ahead and let me know where you are from. Where in the world? Dallas, Texas, Olympia, Washington, Mexico. Nice. Boston, North Carolina. Yep. New York City, California, Pittsburgh, Nash, Vegas. Orlando, Florida, Manila, Fargo, South Dakota, Canada, Stockholm, Sweden. Wow. Farthest traveled for tonight, Stockholm, Sweden. You get the prize. Toronto, New Jersey, Queensland, Australia. Ooh, there's a close. You probably win. Queensland, Miami, Diego. Hey, how are you, Diego? Good to see you. Kentucky, Joseph Smith. Yep, Malibu, Canada. Zach, what's up, Zachary? He lives, I don't know what, 20 minutes down the road from me. Colorado, Fort Lauderdale, Delaware, Philippines, Pennsylvania, Manila. Yep. Portland, Florida, San Diego. Cool. Thank you. Thank you, guys. Well, let's go ahead and let's get started, shall we? Got a full packed session for you guys tonight. Let's go. Oop, let me pull my chat window out of the way first. Here we go. And there we go. So, ladies and gentlemen, tonight we're going to be talking about position trading, right? We're going to be talking about pyramiding. And this is a little bit of an advanced class. This is a kind of a medium to longer term swing trade strategy. And this is something that is one of my 3 strategies that I teach and I use all day, every day. This is bullish and bearish. It has both elements kind of built in, and you can use stocks, options, or both stocks and options. And this is an ideal strategy for a retirement account. So let's start here. Our mission, ladies and gentlemen, is to enrich lives. How many of you guys know that Real Life Trading is not just another trading education company that's pumping bikini babes and jet skis and Lamborghinis and Ferraris? Type RL in the chat pane, the letters RL, if you know that Real Life Trading has a mission, and we are more like a movement than we are a company, right? We have some things that we're trying to do, accomplish in life. And what we're trying to do is reach 1 million people in the next 5 years. So we've got a little tiny head start on that. We got a lot of work ahead of us. I'll be talking about that a little bit more later on. But our mission, ladies and gentlemen, is to enrich lives. Yep. So thank you for joining us. Thank you so much. This is a little bit about me. I am super young. I am 45 years old. Like I said, super young. I have been married for 21 years. I married my best friend, and we have 2 teenage daughters. So 2 teenage daughters, y'all pray for us. If you have teenage daughters, you know what I'm talking about. I'm actually writing a book right now. It's called What Entrepreneurs Teach Their Kids. And that is coming out sometime next year. For those of you who don't know, I actually joined Real Life Trading as a customer back in 2016. And I joined, I kind of take care of oversee all the technology here at Real Life Trading starting at the end of last year. So, and of course, the best music of all is, in my opinion, jazz. My wife hates it because she says it sounds like a bunch of horns and crazy chaos, and but I like it. I love it. It's amazing, right? So here's a couple pictures of the family. I know we don't really get into like personal stuff much, but this is my redhead daughter, Callie. This is her horse, Magma. We flew last year to Ireland, brought him back. He is an Irish sport horse. So he is a beast. This is him. She does what's called eventing. So it's a 3-part, it's dressage, cross country, and stadium or show jumping. And this guy can literally fly. He is, I believe, 16 3 hands. So, yep. And then this is she's a senior in high school. This is my oldest. This is Shelby. She goes by the name Shelby Grace. You can find her on Spotify. She does a lot of, she's a singer-songwriter, and she writes tons of songs. We've published a handful of those already that are out there on Spotify. If you want to check it out. Shelby Grace. She hates our last name, so she uses her first name and middle name. That's her stage name. And this is my wife here. This is Tracy DeLong, and this was taken last year on our 20th anniversary. We went to the Maldives, which is in a bunch of islands in the Indian Ocean. And then this is our puppy, Mocha. She is a fluff ball. We left her in the dryer too long. And Shelby last summer got to sing at the Grand Ole Opry. You guys who are in music may recognize those legendary windows, those, what do you call it, stained glass windows. And that is our little family. Yep. She looks like her mom. Yes, she does. She's like a little mini me of my wife. Yep. Yep. Yes, thank you, Mike. She does have a cool voice. Her genre is Christian pop. So she's written, I think, 15 or 16 songs. We've published 3 of them. The rest, she says she's still working on it. As an artist and musician, you're never quite done with anything. So my question for you guys tonight is, why are you here? Think about this, ladies and gentlemen. What is your why? What is the reason you want to learn? What is the reason you want to do this kind of thing? What is your why? Because trading is difficult. It is absolutely difficult. If you want, go ahead and type some answers there in the chat pane. Spencer wants to help us enrich lives. I love that. We need lots and lots of people. Amy is looking for freedom. Scott McKay, more tools in the toolkit. Yep. More time with the family. Yep. Freedom. Yep. To be retired. Yep. Perfect. Amazing. Yep. Retirement. Cool. So let's start. This is an advanced strategy, ideal for a larger retirement account, or I should say a longer term account. Okay. Longer term account. So let me guys ask you my favorite question of all time. What is your job as a trader? Your job as a trader is to blank. Fill in the blank, ladies and gentlemen. Type it into chat pane. What is your job as a trader? And I hope you guys get this right, because we go over this all the time. It's not to make money, believe it or not. So for those of you who are new to real life trading, your job is not to make money. Now you're probably shocked that myself as a trader would say your job is not to make money. Your job is to execute your plan. Now, why does that matter? Well, we want to take all the decision making, all the things that happen throughout the day, and in a safe environment. We want to craft a plan. We want to put some ideas together on when you should and shouldn't be trading. And then your job throughout all the emotions and drama of the day, the presidential tweets or the Jay Powell, Fed news, all the things that happen throughout the day, your job is just to stay focused and execute on your plan. Okay. Does that make sense? That should take a whole huge weight off of everyone's shoulders, because your job isn't to make money, it's to execute your plan. So ladies and gentlemen, if you execute your plan and your plan loses money, that's not your fault. You did your job, correct? You did your job. You executed your plan. Now, if your plan makes money, that's great. If it loses money, that's okay. Your job's to execute your plan. Now, obviously, if you have a plan and it has some kind of edge, something that has a better than 50-50 odds, and when you win twice as much as you lose, I like those odds. I will take those odds all day, every day. Okay. So I just want to make sure you guys are familiar with this, because this is an intermediate/advanced course. I want to make sure that you guys are familiar with buying stocks and options. Is everyone kind of done that before? Hopefully this is obviously not an intro to options class, but I want to make sure you guys are familiar there. We're good, right? Have you guys sold covered calls before? It's kind of the easiest kind of intro to options selling, kind of the easiest, we'll say, training wheel strategy for selling option premium. Yep. Okay. Everyone's with me still. And then have you guys bought protective puts before, right? So a lot of times people will buy protective puts over a big event like earnings. They'll buy a protective put, and the protective put helps prevent against the downside. So you keep your shares, you buy a put, and it kind of is insurance against a lower move. So I want to introduce you guys to a couple terms that we're going to use tonight. A pyramid. How many of you guys have heard us talk about a pyramid? How many of you guys say yes or no if you have not, if you would like this defined? Hopefully you guys are learning something, and we're going to teach you something about kind of this strategy. Okay. So pyramid is buying shares at 3 to 4 predefined pullback levels. Yes, Nitro. And so we set up pyramids, and we're not in Egypt, right? We are elsewhere in the world. We're setting up pyramids, and I'll walk you through this strategy. But the idea is you buy shares at 3 or 4 predefined pullback levels, right? And so what does that look like? Well, I realize it's a little blurry, but let's say that we're going to buy 10% up here. So we're going to buy, if this pyramid represents different stock prices, we're going to buy 10% up here. We're going to buy 20% here. And I think you guys can see this is 30% down here. And then our final is 40%, right? So let's say that we want to buy a total of 1,000 shares of something. 10% would, of course, be 100 shares, right? 20% would, of course, be 2,000 shares. 30% would be 300. And then 40% would be 400. And the idea is that you're trying to buy at lower strikes, and each price you're kind of building a little bit more, which is why it's kind of considered a pyramid, because you have a bigger base on each one of these, right? You're buying more shares at each level, right? Now, what's interesting about pyramids is that most people say, well, you shouldn't add to a loser. Well, I would preface that and say you shouldn't add to a loser unless that's part of your plan, right? You want to dip your toe in, you want to get a little bit. Jeremy will say, buy 10 shares, right? Buy 10 shares of this, 2 shares, 5 shares, something small. And you're kind of building a starter position. And then as price maybe comes back lower, you're getting better and better prices on those. And this is not something you would try to day trade. There are strategies for that, but that's not what I'm teaching tonight. And then this is a strategy that's a little bit longer term, okay? Makes sense? You guys with me? Okay, so next is a collar. How many of you guys have heard this term or unfamiliar with this? A collar. So a collar is basically when you sell an out of the money covered call. So if I was to trace this, and let's say that each candle represents a day, and as I'm making new highs, right, I'm going to be selling. Let's say that I make an all-time high here on my chart, and I'm going to sell an out of the money covered call. And let's say, for example, just for easy math, I get $7, right? And it could be $2, it could be $5, it could be $1.50, it could be whatever. But for our example, we're going to use $7, okay? And so let's say that we're going to sell an out of the money covered call, and we're going to collect $7, right? So it's plus $7, okay? Then we're going to buy an out of the money put, which guess what? It costs $7. That's a terrible 7. Let's say that this costs $7. So we're collecting 7 and we're spending 7. Ladies and gentlemen, how much is our cost? If we collect 7 and sell 7, how much money did it cost us? 0. Okay. So you may have heard this called a zero cost collar, and it's not always 0. Sometimes it's just low. Maybe you sell it for 7 and the lower put costs $7.50, right? It's a lower, it's not always 0 cost. Ideally it is, but it's an inexpensive way to buy protection against a lower move. So next, you guys may have seen this. Hollywood is talking about this, right? How many of you guys are familiar with the show Billions? Oops. Billions. Yep. So this is a TV series on Showtime. It came out a few years ago. I think they're on season 5 or 6 or something like that. But this Taylor Mason was she was an intern and working for a portfolio manager. And the portfolio manager is like, hey, I need to dump a huge block of shares. But in order to do that, I'm going to tank, the price will tank. And the suggestion here was you need to sell a $45 call and buy a $40 put. So what does that actually do? Well, what actually happened was $40 put is, guess what? I'm locked in. So if this was a stock chart, my $40 put, I am locked in, meaning if it goes to 0, I am guaranteed at least $40. So the portfolio manager is trying to get $40, And the recommendation was sell a $45 strike covered call. Well, they didn't say call, but it is a covered call. A $45 call, collect the money, and use that to buy a $40 put. Make sense? Yep. So how far out for the expiration date for call? It's really up to you. There's advantages and disadvantages for going super far in the future. At the short answer is that if you sell a 30-day collar, which I use typically 30 to 60 days, but either one, if you set up a 30 or 60-day collar, or even a year collar, at the end of the day, the money that you collect, because you're using the same expiration for both of these, right? For a $45 call and a $40 put, either way, you're collecting kind of a similar amount of money because you're selling a call option, let's say a year into the future, you're going to collect some nice dollars. But to buy a put a year in the future, it's going to cost you some nice dollars. So regardless of whether it's 30 days, 60 days, 90 days, those are usually what I use, 30 to 60 days. Regardless of that, you're going to collect some nice premium regardless. Okay, so let me turn my tool off. Next, I'm going to walk you through how this works. Oh, and this is the definition here. But I got this right from Damian Lewis's fan page. They were talking about this. I'm like, oh, cool. So next is the strategy. Here's how it works. So find we'll say step number one. We want to find a stock that is on an uptrend on a daily and weekly chart, right? And we want a pyramid on the way down. So this is Teladoc. So for those of you who are not sure, like, where do I decide to buy lines? One easy solution would be buy off the 100. That's my blue line. Jerremy uses the same blue lines or I use the same lines he does. This is a 100 simple moving average, and this is Teladoc on the daily chart. The red line represents a 200-day simple moving average, right? So let's say that Teladoc has made a nice run up, and you're like, I want to start building a pyramid. Well, buy some here, right? And then buy some off the next. So you would buy, in this case, it happened to be like, 2 months later down the road. But imagine buying some off these moving averages, right? And you can certainly set up maybe a lower price. So if you look at the chart, you can see that there's some congestion, maybe buy a little bit more down here, okay? So the idea is to kind of leg in and tippy toe in. You do not want to be the guy here that bought at the highest price and went all in. And let's say he wanted to spend a fixed amount of money, and you say, I want to buy X number of dollars, $10,000 worth of Teladoc or $50,000 worth of Teladoc. You want to be the guy that goes all in right here at the highest high, and then 3 or 4 days later, you're kind of worried about kind of the big move that just happened. So this is how this works in 3 steps. Is you want to identify the areas on the chart that you want to scale into, and you buy a small number of shares each step of the way. So here you buy, like I mentioned, 10%, then 20%, then 30, and then 40, right? You have different legs, different strike price, or different levels that you want to buy into. And again, if you're not familiar with where to pick those lines, the lines themselves don't necessarily matter. The market and the stocks are going to do whatever they're going to do, regardless of what we say, regardless of what we want it to, right? How far down is too far down? Ideally, above 0. You don't want to buy at 0, right? But just a common support and resistance would be a good spot. So if you're playing a weekly chart, you can certainly use the 100 and 200 on a weekly. 100 and 200 simple moving average on a weekly, and same thing on a daily. Those will typically give you some good levels to buy off of, and those are good spots if you aren't familiar necessarily with drawing support and resistance lines or support levels. So so the other thing is you want a pyramid on the way down, right? So you want to set this up as you want an uptrend, but then as it pulls back, you want to set up different levels that you're going to be buying, right? You're going to be setting up your pyramid. You want to have 10, 20, 30, 40%, or 10%, 20, 30, and 40, right? And so maybe the stock does something like this, and then you want it to go higher. And so those of you who've been trading pyramids or position trading for a while, you know that sometimes a stock doesn't actually make it all the way down there, right? Sometimes a stock will hit your first level and then rocket higher, and you only have 10%. That's okay. That's okay, right? You certainly don't want to chase it higher, but sometimes it'll hit your first and second level and then continue higher. Sometimes it just rockets higher, right? But that's okay. And so the idea though is that after you have set up your pyramid, either partial or full, you can sell or set up a collar on the way up. And you'll remember when we talked about this, a collar is selling this is our stock price, selling an out of the money covered call, collecting some money, and then buying, say sell a covered call up here, and we're going to buy a protective put down here. Now, whether it's 30 days, 60 days, 90 days, a year, there's advantages and disadvantages to this. We'll talk about that in just a second. Is everyone with me, right? So identify some spots where you want to pyramid or you want to leg in, right? And then you want to set up a collar. Now, once I have a collar set up, ladies and gentlemen, what I'm basically saying is anything below here, I am protected, right? I am good. I am protected all through here if I have my put at a certain strike price, right? But the downside is I'm giving up my upside of this, right? And I'll show you some of the timing aspects of this, of when to get into this and when to time it and try to make this work the most in your favor. Okay, so here's a question, A or B, ladies and gentlemen. When is a good time to add a collar? When's a good time to set up a collar? Some of you say A, some of you say before B. Albert says all-time high. And the answer is yes, that's correct, A. A is the correct answer. And the reason is, if you have a stock that has a little bit of a pullback, kind of rockets higher, and you see this big, massive candle, you guys know that if you want to buy a call up here, it is going to be pricey, right? Because of the volatility, the implied volatility, right? It has made a big old move, and don't be the guy that buys up here, right? You would say that you're chasing it, right? Because who wants to buy up there? You want to wait for some kind of a pullback. But if you miss that, if you're buying a call, but ideally you want to sell at all-time highs, that would be the absolute best time to do that, okay? So let's say that these, I just took a random stock here and put this chart in, but let's say that this represents $50. Let's say this line represents 40. This is 30, right? And then this is, well, like, this can't be zero. Let's just put a zero on the end. 200, 300, 400. Okay. I think I got this from Teledoc, but let's say that you want to set this up. And when you have, obviously when you have a nice candle like this, and let's say you have 1,000 shares, why not go ahead and set up a collar maybe on, I don't know, maybe 25% of your position. So 250 shares, right? 25%. And what you could do is say, I want to sell a 500 strike, and you want to do it on maybe on this day, right? Now, obviously at that day, it was an all-time high based on our chart. These days hadn't necessarily happened, so we can set up 25%. And let's say we collect, like I gave in our previous example, we collect $7. And on this kind of a move, we want to collect $7, and we can set up a put here, and we can spend $7. So it doesn't matter whether it's 30 days, 60 days, 90 days, a year. Again, you guys can see how you're kind of locking in profits without actually like selling and realizing a gain. Now, ladies and gentlemen, I have done this. I think on Pinterest, I did this for, I want to say about 5 months, something like that, where I would sell 30 to 60 days. And it finally got called away from me, which is fine because I had, I think, an average of a $20 cost basis. Now I'm kicking myself thinking, well, I probably should have done a partial collar and let some of that ride. But That's the idea. You guys with me? You understand? Now, obviously, if you want to sell a covered call, this is not the time to do it. Correct? That is not the time to do it. This, you can do it, but you're getting pennies on the dollar, right? And you guys know when you're hitting new lows, that is not the time to buy a put. You want to have all that up locked in and set up ahead of time, right? It's like buying insurance for your car before the car accident happens, right? You want to have that set up ahead of time. You don't want to wait for that to occur and then try to get in, because you will be overpaying. Now, have you guys recognized this guy, Mark Cuban? If you've ever watched the show Shark Tank, he by himself has more wealth than all the other sharks combined, which is pretty amazing. He owns the Dallas Mavericks as well. And so I have an interesting story here. You guys may or may not know this, but Mark Cuban is a big fan of the collar, kind of what we're talking about tonight. So he received a small, measly sum in the amount of $1.4 billion. Let's change that. $1.4 billion. That is a nice little sum, right? A couple zeros on the end. So he sold his company, broadcast.com, and he sold it to Yahoo in the early, I think it was 2000, it was January. No, it was 1999, 2000, somewhere around there. So he sold his company and received 1.4 billion, but he didn't receive it in cash. He received it in stock, right? So Yahoo stock. Okay. So this was back when the stock was trading, Yahoo was trading at $95. $95. Okay. So Yahoo ended up going way up to 237, which is crazy. 237. And at the time, when it was $95, he did exactly what we're talking about tonight. He sold a 205 call, covered call. Okay. And he bought an 85 strike put. Now, for those of you who set up a collar before, as probably the most famous collar of all times. For those of you who have set up a collar before, if you sell a 205 and the strike goes up to the stock price goes up to 237, will your covered call and your put, those will be red or green on the P&L? Red. Everyone's saying red. And the answer is red. It'll be red because let's say you sold it for $8 and then it's now worth something more than $8, a lot more, right? So on your P&L, obviously he would get called away at 205. He gets to keep the $8. Now that seems like a kind of a bonehead move, right? But wait, you guys know what happened with the .com era and what happened with Yahoo. So at this point, it looks like it's kind of a mistake, right? And then let's see, he went down, ladies and gentlemen, down. Can I draw down here? I got to do it here. $13. So are you glad that you had the $85 protection when it goes down to 13, right? It's like, I will be calling in an insurance claim and I will be selling my shares at 85 and the rest of the punks in the world can sell it at 13. You guys see how that, like, he literally protected $1.4 billion. Now, some of us don't yet have the stomach to trade and have lots and lots of shares like that. He had the article I was reading, he had 146,000 shares. So if you do 146,000 shares times around $95 is 1.35 billion, rounded to $1.4 billion. So that is kind of the most famous example of a collar. I want to make sure you guys understand that. Does anyone have any questions? Let's see. The idea is that you get called away at a great target price. Yahoo is not publicly traded anymore. I'm not sure. I forget what happened to Yahoo. I believe somebody bought them and they went private, if I'm not mistaken. Someone can correct me. Yep. He did it to all position. According to the article, which I don't know Mark personally, Jeremy has him on a speed dial. I'm joking. I believe it was all of it. Yep. Yep. Let's see. Did he set up a collar at the same time because the 205.85 in the stock market trade today would be a massive debit? So in this case, he obviously is giving away $10 of downside. So if you add, $1 on the end of that, that's still a lot of money that he's giving away. And at first it looked like a bonehead move when it rockets higher, but then and I believe the way it worked was he had a 3-year lockup period, I believe. So they gave him shares, but he wasn't able to sell it for 3 years, I believe is what the story was saying. So it represents obviously for 100, actually I told you guys wrong, 146,000 contracts. I apologize. 146,000 contracts is 14.6 million shares, right? Times 95, and that gives you the $1.4 billion. And there was a 3-year lockup period, and that's kind of how he did that. Let's see. So I'm saying Verizon. Okay, yeah. So Verizon bought Yahoo. He did not pyramid in his because he got it in a lump sum when he sold his company. Yep. And most of you guys know that Google, you may not know the story, but Google, when they were just an algorithm, Google went to Yahoo and said, we want to sell our algorithm for $1 million. And Yahoo laughed at Larry and Sergey. Now, my company that I owned previously, we actually did business with Google. We got invited to the Googleplex campus outside San Francisco. And it's massive, massive complex. It had food court, all that. This is, so I was there last time a few years ago, 2008. And Yahoo had the right to buy Google when it was just an algorithm, right? They weren't a competitor. They were just an algorithm. These college guys had put some hardware and software together, and it was Google, just an idea, rough idea, was an actual full company at that time. And Yahoo said, no, thank you. Now, how does a $1 million no turn into a several $100 billion mistake? Ladies and gentlemen, that is how. Same thing with Netflix and Blockbuster Video. Netflix had the right to buy Blockbuster. They tried to compete against them, spent more money than what Netflix was asking, did a terrible job, and we all know what happened to Blockbuster Video. Yep. Yep. Let's see, how many shares did you get of Google? So they hired my company to do work for them. I got 0 shares of Google. Yep. Yep. And Yahoo was kind of the popular, I believe, I remember buying computers where Yahoo was like the default search engine. This is there was like Excite and Yahoo and Alta Vista and a handful of them, but Yahoo is kind of like the premier dominant company, which also means if you sit on your laurels and do nothing, someone else will out innovate you and you will disappear. Yep. Yeah. What is Blockbuster? Blockbuster absolutely blockbusted. You guys. Oh my goodness. Okay. So let's talk about the recipe. Here's my recipe. This is something you can set up for 15 minutes a day. It doesn't take a long time to set up. This is a 3-week plus hold time frame. I do not recommend you trying to day trade this exact strategy. There's variations, of course, and it is on a 1 to 5 scale. This is a 4. So again, you need 100 and a 200 on a daily chart, right? Those are your ingredients and your steps. We're going to recreate this recipe. I'm giving this to you guys. Is that you want to identify stocks with an existing uptrend on a daily chart. I should have added in here weekly also. Daily and weekly chart. And again, you guys are familiar, bottom left to top right of a screen, something like that, right? That is a uptrend, and you want stocks that are pulling back to the 100 and 200. Now, I did build a previous shortcut scanner right here. If someone could type that into the chat pane, I'd appreciate that and share that with the group. That is kind of how I look for companies that are growing quickly. They're growing their revenue. And for the next step, we're going to buy 10%, 20, 30, and 40. So ladies and gentlemen, if I buy 10 plus 30 plus 40 plus 10 plus 20 plus 30 plus 40, that will equal 100%. Now 100% could whatever 100% is that you want. If you want 100 shares or 1,000 or 10,000, or in Mark's case, millions of shares, right? It could be whatever number you want. And so you're kind of legging in small pieces. You're tipping your toe in, then you're putting your foot in, then your leg, and then you're kind of all in. So at this point, once you get filled on 40%, then you will be in 100%, right? And then once you're profitable and on an up day, and you have to think about the timing of this, you can sell that out of the money covered call like I referred to before. If this is an all-time high in ATH, we can sell a covered call up here, sell a CC, and we can buy a put down here. Buy a put, P-U-T. Boom. Okay. And again, whatever you sell up here, let's say it's $7, $8, whatever, you can spend you get plus 7 up here, minus 7 down here. Okay. And you can use those funds to buy in out of the money protective put. And this is like what you guys have asked about, is how far in the future. It's really up to you. I don't like to go too far in the future just because of these growth companies. If you sell a covered call, obviously, let's say your average cost basis is down here somewhere. Obviously, this is not drawing the scale, but let's say this is your average cost basis and you're selling it up here. Obviously, the difference between here and here is your profit per share, and you're also collecting a $7 premium on top of that. Now, that kind of a move is not going to happen in 2 days, 3 days. This is going to be weeks, if not months, right? So it's a bigger, longer term. Yep. How do you manage your total risk though? So great question. So it depends on how big your 10%, 20%, 40% are. So for those of you who type a CC in the chat pane, if you have ever set up a covered call. Now, selling option contracts assume you have at least 100 shares, okay? And that would be a 100 share covered call. Now, obviously, if you are, if you're buying 10% and let's say that represents 10 shares, then you would have to have a full position, right, to get in to have 100 shares, 100 shares for a covered call. Now you can also have 400, right? It's kind of like increments of 100, right? That's the idea. And so if you have increments of 100, you can set it 4 contracts for a caller. Okay. And now it is a little bit tricky if it's a higher price company like a Shopify, like an Amazon, and you don't have the buying power to set up to buy 100 shares of the actual underlying company. Obviously, Amazon being in the thousands, 100 shares is a lot of money, probably more buying power than what's available in some of our accounts. So what you could do is you could also leg in and you could use options, right? You can buy options. And then once you have options, you can do what's called a poor man's covered call. It's basically you're doing the same thing where you're selling a covered call against, let's say you buy a Leap. Let's say Leap is a long-term equity anticipation. Okay, let's say it's, I think it's 9+ months. So an option that lasts, I believe it's 9 months or longer. So let's say I buy a 1 call option here, 2 here, 3 here, and 4 here at varying strike prices for maybe the same expiration. As the stock kind of pulls back to my levels, I'm filled, right? But as it goes higher, I can set up callers and sell covered calls up here against my, I'm sorry, in that case, it wouldn't be a covered call. It'd be kind of like what's the word I'm trying to think of? It's you're selling call options against your long calls, right? So like a poor man's covered call. Does that make sense? Okay, so a question came in. Are you pyramiding setting up the caller over several days or at the same time? So great question, K-Dog. You can do either. Obviously, if you're buying in different legs, you don't want to buy all at once, but you can set up 4 different limit orders, right? So you can set up, you just need to be mindful of when you set them up that you're setting up good till cancel orders, GTC, right? Again, you're buying 10% here, 20% here, 30 here, and 40 here. So if your main goal is to have 10 contracts of something, then you're going to be buying 1 here, 2 here, 3 here, and 4 here, right? As the price goes lower. Now, of course, you have to be mindful. This is a small position, right? Compared to 2, which is a small position compared to 3. As the price goes lower, before you hit that number, that last buying level, that last buying tranche, before you hit that, these will be red, right? These trades will be red, but you have to make sure you understand that and that you're not going to panic, right? Because you want to tippy toe in. But let's say you have one contract, let's say it's of Tesla, right? And you're down $1,000 on something that maybe is a year call option, you know, and you spent some pretty pennies on that. As you go lower, you're going to get more and more red. But the idea is you're expecting some kind of a bounce, right? Some kind of support, something that gives it the ability to reverse directions and go higher. So I will show you this live here in just a second, some of what I did on a couple of my trades this year. But for those of you who are in the real life trading room, some of you guys see a lot of people posting 10, 20, 30% gains, sometimes 50 and 100. Right, the higher up it is, the less likely it occurs. But some of us have been working on some of these trades for months, right? So so if I say I made 30R in October, that doesn't mean I set it up all in October and exited in October. It means I exited in October, but some of the stuff I have set up months ahead of time because this is a longer term hold, right? It's not something that would happen right away. So Mithun asks, does the caller about protecting gains, or we want to make money out of it? It's actually protecting gains. Yep. You ideally, because it didn't cost you anything, you don't necessarily want, I suppose you could, but it's kind of a different risk profile. It's trying to make a profit off of it. But ideally, you do not want to profit from it. It's really about protecting the gains. Yep. Our RBC Direct Investing does not offer the option for selling a limit order. You can't sell a limit order. How do you exit a position then, George? How does that work? Are you talking about an options, or are you talking about selling covered calls? I'm not sure. Yep. For the out of the money on both sides, how many ticks up and down, any specific delta? Diego, that's a great question. And it's a little bit of a feeling there. It's not necessarily something hard, fast number rule I can give you on how and when to do this. Obviously, if you look at your P&L and you're up massively on one position, it might be time to set up. You have to look at the chart, but I'll show you some examples here in a minute. Yep. Yep. But at some point you may be down more than 1R. So Jean, you might be down more than 1R, but in a retirement account, that's why this is great for a retirement account. You don't necessarily have stops, right? You don't use stops. What you do is you buy a big chunk and you let it ride and go higher, and you use the collars to protect it as it goes higher, right? So I'll show you how this works in just a second. So let's say here that you have, let's see, this is Teladoc. This is one of my new ones. I'm actually setting up some orders on. This is Teladoc on a 1 day. This is a daily chart. And let's say I kind of made some new highs, right? This is back during COVID. And let's just say for easy explanation, I want to buy some here and some here and some here. Now you guys may not see this, but there's a lower wick that stops right about there. Doesn't quite hit my third level, right? So in my example, I'm just using 3 tranches, I'm buying at 3 different levels. I'll get to that in just a second, Frank. 1 sec. So let's say it doesn't quite get to my level. I'm sorry, let's say it doesn't quite reach my third level, and I only have maybe 30% of what I wanted, okay? But let's roll to the next slide. Let me clear. Roll to the next slide. And let's say that I want to buy, in this case, 50 shares at $140. I'm going to buy 100 at 120 and 150. So I'm total all in about 34,000. You guys see how I came up with that? And let's just say I'm setting this up. I don't know what's going to happen into the future. That's kind of what I'm going to do. Yep. And then let's say it rockets higher. Well, in this case, depending on where I got, I'm sorry, in this case, I'm in 100%, right? Now, where on this chart, guys, would it make sense to actually set up and sell a covered call? Obviously, we know what happened. This is up till, I believe this is today or yesterday when I took the screenshot. This is November 12th, so yesterday. So if I'm in 100, if I'm in, I only got filled on 30%, then in my case, if I go back one, I only have 150 shares. You guys see that? In this case, it didn't fill me on this lower level. So I only have 150 shares, right? So I can set up a collar, but only on 100, it's only going to cover 100 shares, right? I could buy one contract of a call, right? Which would give me essentially 250 shares. And I could set up something against that, a collar against that if you wanted to. But the way that this works is, again, we're waiting for pullback. We got filled here, and then it rocketed higher. And a lot of these growth stocks, that's kind of what happens. It absolutely rockets higher. So on some of these days, obviously like this, you kind of made a new all-time high. So you could say, I want to sell a covered call up here, and I want to buy a lower strike price, a lower protective put here. You always can do that. In this case, we're talking about, that is a $40, $50, $60 wide difference. Probably a little more than what you'd be comfortable with. Probably a little more than what I would do. But you guys can see, depending on if you set it up here on this day and you sold 30 days out, right, you'd be in the middle of June, or even 60 days, you'd be at, let's see, June would be, the third week would be right here, I believe. So this would be the third Friday of June, roughly. And if you set it up for the 3rd of July, you would be somewhere over here, which you would probably, depending on which day exactly, you may or may not get called away. But if you have an average here of, what is that, 140 plus, what is your cost basis? There would be $19,000 divided by 150. Your average cost basis would be about $126, $127, right? So if you have an average of 127 bucks and it was taken away at 220, plus you kept, you kind of kept you were able to put a collar in place and kind of keep your gains in place without actually selling, no one's going to cry for you, right? That's not bad, right? Almost $100 a share, right? You're gonna be looking pretty, right? So Frank, let me get back to your question. What's the plan if it doesn't come back? Sell CCs, reduce your cost base until it does. Are you talking about coming back, meaning if you get filled lower and it just goes lower? Is that what you're talking about? I think that's what you're asking about. Okay, yep. So typically what I would do is you could certainly do that. Obviously covered calls, you get more premium on an up day. You can certainly do that. Typically what I've done is I will, if it continues lower, I will look for some of this volume spikes like here. In this case, if it closes above, I have a pretty good idea. If it closes above that volume spike and it's a red selling day, if it closes above, that's the volume pinch that I talk about in the afternoon room. And it means we're going to be going higher. So no worries. You obviously can also buy your own puts. Buying a put on a sell-off is the most expensive way to buy a put. That's not the ideal way to do it, but of course you can. Again, guys, this is a longer term thing. So you're not necessarily playing for this month, next month. You're playing for maybe months or years down the road. Some of these companies you may want to hold 5-10 years. If you guys ever looked at a stock chart of Shopify, actually, let's go look at a stock chart of Shopify. If you've ever looked at a stock chart of Shopify, what it did in the past couple months is nothing compared to where it's been over time. So let's take a look at this. 1 sec. Let's take a look at Shopify. So Shopify, You guys could have had pyramids built at any levels. We talked about the 200 and the 100 simple moving average and the 200. You obviously kind of went lower. This is kind of COVID. You guys know what happened there. And that's, which by the way, double bottom, but by the way, as this was happening, this is where Shopify is building their 90% revenue growth, right? So some of you guys are panicking. Shopify is putting in new all-time high revenue numbers, growth numbers, looking pretty snazzy because of all the lockdown. People are staying at home, people starting their businesses. Sometimes people are on unemployment. When I ran my e-commerce software company, we started in 2008. So we launched it and we thought it'd be cool to launch it on April Fool's Day. So another story. But it was right in the middle of the whole foreclosure crisis, right? Everything was falling apart. But most of you may not know this or may not have thought of company. Like if someone is on unemployment and they're at home for 3 months, 6 months, and they have small business ideas, maybe they want to sell something, maybe it's handmade leather, chocolates, whatever. During the time where you're getting unemployment, and you have nothing else going on, that is the #1 best time to launch some of these companies, right? So during COVID, when some of you guys are stocking up on toilet paper, there's people literally building small fortunes, right? So just think about that as far as a bigger time perspective is a superpower, right? Yep. Okay, let me see if I can get to any, if I'm missing any questions. Pick a company you believe in and just hold it. That's right, that's the idea, yeah. So I would also, guys, Frank asks about building the pyramid if it keeps going lower. So ideally what you do is you have a set amount you're willing to put in and you don't violate that, right? So you have 10%, 20%, 30%, and 40%. If it goes below that, do not add to that, because that is where you're breaking your plan. Your plan was to buy 10%, 20, like this was your plan, right? And you don't want to violate your plan, because at the end of the day, your one and only job is to execute your plan. That's it. That's all you got to do. That's all you're responsible for. That is your one and only job. And if you had this, we've talked about it before, is this extreme accountability where you give yourself an A+ or an F. You either did it, you executed your plan exactly, or you didn't, right? Lots of us have accidentally typoed a quantity and an order and fat fingered something, and we bought 1,000 shares instead of 100, and we're down 7R in 2 minutes. Like, we've all made all of these mistakes, right? We've all made all the noob mistakes. That's my superpower. I'm really good at doing things wrong. And that's kind of how I learned how not to do things. You got to figure out what not to do before you get towards what are the things that you should do. But again, all this to say is that if your plan is to have 4 different, you're legging in 4 different positions, you do not want to add a 5th, 6th, 7th, 8th, because that is how you blow up your account. And your job as a trader is to execute your plan. And your plan, most of your plans, I haven't seen them all, but most of them should say, don't blow up my account, right? Don't go to 0. Don't be that guy. Okay. Let's see what other questions you guys have. If you're out of the dough, yep. So again, ladies and gentlemen, this is a way to kind of protect your gains without actually selling. As you can, let's walk through this real quick. Let's do this on Shopify. Let's pretend that we're going back early part of this year. This is like the COVID is just kind of becoming a thing. You guys see Shopify over earnings made an all-time new high. You guys see that? And let's say we want to buy off this level, and let's just, for easy example, we want to buy off these 2 levels, okay? And let's pretend that we want to buy, let's just say 300. No, let's just say we want to buy 100 shares here. Yeah, 200 shares here, okay? So as we walk through this, we have not been filled. We are not up, we are not down. We are going Oops, we are just hanging out, waiting for our orders to be filled. Now, some of you may be tempted to adjust your orders, right? And push them higher and like, I want to buy up here, but let the strategy play out. Let your plan work for you. Every single company that I've ever looked at and back traded that pulled away from their moving averages a whole bunch, they end up coming back. It's like a rubber band. It can expand so far and it comes back and contracts. So at the end of the day, you really just want to execute your plan. So let's remove my drawings. Let's see. Okay, so let's move this out of the way. There's my one. Give me a one. So here we would have got filled at the 393 level, right? And each time, as you guys know, as we go forward, the simple moving averages are going to adjust a little bit. But let's pretend that we bought 100 shares here, okay? And we are going to be kind of break even a little bit. Now we're down, okay? So let's say I bought some more here. So I bought 100 at this green line and 100 down here. Now I'm in a full 300 shares, right? 300 shares. And this is not looking super bearish, or I'm sorry, super bullish. This is not what I want to see if I own 300 shares, right? Now this kind of makes a new low here, a relative low, and then turns around, kind of, it looks like it's about to rebound. Now we probably all know it's going to go sideways and it's going to go higher, okay? Now at this point, ladies and gentlemen, we are in 300 shares in total. Our average total would be, let's see, what is our average? Let's say 394 plus, let's just say 360 plus 360 divided by 300. Our average would, that's not correct. 394 plus 360 plus 360 divided by 3 is 371. So our average is $371. So ladies and gentlemen, at this point, we are closing up at 446.60. Nice move. Now, we're not really approaching all-time highs. We could do something here. We have 300 shares, so we could think about, do we want to, at some point, do we want to add a collar? Maybe we want to do it off 100 shares, maybe 200, maybe 300, right? And here we are back to being up to now red. Now, for those of you who panic, don't panic, right? You're going to execute your plan. Let's see what happens. We all know if you execute your plan over time, it's going to win. Now, look at this. We're almost an all-time high. So right here, ladies and gentlemen, this might be a decent time to say, hey, I want to sell. You got 300 shares to work with, so you have up to 3 contracts. But let's say you want to sell a $700 covered call here. And let's just say we want to do 30 days. So here we are, April 20. So what was May? May, the third Friday in May is the 15th. So May 15th. So right here, May 15th, we're going to sell a 700 strike, and we're going to, let's say we're going to buy a put here. And let's say that whatever we collect in premium, we spent here. Okay. So whatever happens, if the price crosses my line and we're up here, it gets called away. If it's down here, we're protected. If it's in between, our collar expires worthless, which is fine. That's fine. That's what we want. So let's see what happens. I don't know what happens. Let's see. What do you think is going to happen, ladies and gentlemen? Oh, let's cross expiration date. Not quite, almost. All right, so there we go, ladies and gentlemen. Our shares get taken away from us, but we had a 371 cost basis and we sold it at 700. Ladies and gentlemen, that is almost a double. Round of applause for yourselves, right? 300 shares, almost doubled. Now, in this case, 300 shares times 371 would have been a big 111K investment. Now, obviously, we're talking about shares. Now, if you bought one contract here and 2 call options down here, it would have been a more inexpensive way to do this. The volatility was kind of chopping around. So it would have been another kind of alternative way to do that, right? Does everyone follow me? So again, you would have almost doubled your money in a matter of what was it? A month and a half, something like that. Execute the plan. Step 2 is C, step 1. Yep. So as far as cash size, it depends on what you want to do. So Warren Buffett, I believe, has 25 positions. I see some of you guys' portfolios, you share them, like my coaching students, and some of you guys have hundreds of positions on like $100,000 account. And I would recommend you have less positions with more dollars behind them, and then use these kind of strategies to kind of lock them in, right? But obviously in this case, if we had a put here and it went down to 160 after in this time frame, obviously would have been protected, right? We would have still locked in a 500, an exit price of 560 when our entry was 371, right? So that's almost a good $200 gain, 190-ish, right? So again, you're setting up the pyramid so that the price can come back to you. And typically, yes, I use limit buy orders. That's typically what I would do. Only because you want to be able to specify the price. You want to know what the price is. You don't necessarily, you don't want to get put shares using a stop order to enter something like this. You want to wait for a pullback, right? And in my case, for those of you who are joining us, I just based it off of the 100 and 200 simple moving averages when I drew my lines when we started this little exercise, right? Yep. Careful selling puts if you can't buy at that price. So in my case, we're actually, Jay, we're actually selling covered calls and buying puts. So we're short calls, long puts, right? So we're selling, so we're selling covered calls up here. Oops. We are selling covered calls up here, and then we're buying puts. We're not actually selling puts. So I do teach a put option, selling put option class. That is not this class. That is a different class, but that's what that was. Yep. So yeah, some of you guys are the guy who buys up here because all the excitement. I want to go higher, and right, it poops its pants, and then you sell, and then it rockets higher. How many of you guys have ever had that? I've done that many times, and I learned, don't do that. It's pretty simple. Don't do that, right? Okay. Cover call is like a cheat code. That's what CC stands for, right? Cheat code. What happens if it reaches the put strike before expiration? You could just straight buy then too. If it reaches the put sale strike before expiration, yes, you could. But again, if you're trying to hold this over months, weeks, months, some kind of a longer term, you want to be kind of parked your money in this for some period of time. And again, ladies and gentlemen, this is not a super active strategy that you're monitoring all day, every day, like you would a day trader, or maybe a shorter term swing trade, which is perfect for something like a retirement account, which happens to be a little bit bigger account. Most of your retirement accounts are bigger typically than your trading accounts. So, yep. And again, your job is to execute your plan. Do you set levels based on the premiums for the calls and puts? You can. Typically, you want to look at the actual stock chart. That's what I do when I decide what I want to do. Obviously, the higher strike calls get less and less premium, the farther out of the money they are, and then that gives you a little less money to buy your put. So you just have to kind of play that by ear a little bit, but that's typically how I set that up. Okay. The alternative way to do this, Albert, is when we bought our when we legged in our 2, instead of buying, we're still limiting buy, but we're going to maybe buy maybe a 0.4 delta call option, either 30 or 60 days to expire. Right, so we're buying a call option. In this case, we're looking at like a $400, $403 per share. Obviously, as you guys know, to buy a call option is not going to cost you $400. It would be a fraction of that, right? So that's an alternative. Another one would be to buy limit buy 0.4 delta. Another one, call option, which would be a different lower strike put I'm sorry, lower strike call option DTE, right? So you're kind of buying in. This is a super simple example too, ladies and gentlemen. Obviously, as the stock pulls back, this is the alternative if you don't have a bigger account. This again is kind of a little bit more longer term. This is not a quick in and out in a day kind of strategy. Because when you have, when you sell a covered call, you still have a liability, right? You can't just like close that down and say, never mind. You promised, you have an obligation to deliver those shares. The buyer of your call option, they have the option to exercise that, right? So in this case, the alternative is not to buy the shares, but to buy some call options. Yep, Albert, that's how that works. So where would you have put the stop after you initially got the shares? Around 310. So in my case, I actually would not use a stop. So in retirement, bigger accounts that are more longer term, you can absolutely get chopped up using a stop inside a bigger move, like a high beta stock like Shopify. I would not use a stop. What I would do for the question should be probably, how do you manage your risk? And to do that, I would look for some opportunity to buy lower strike puts. If it's kind of breaking a new low, absolutely, I would do that. Now that is the most expensive way to buy protection. But again, these are companies that I want to hold long-term for some period of time, more than just a few weeks and months. So this would probably be a good strategy for 5+ years if you want to hold the stock 5+ years. And I've never made it 5 years because I get called away, but I have held for 5, 6, 7 months on some of these. Yep. And you set up the collar expires, you wait for a new high, same thing, right? Yep. When is the CC a no-no? Give us a quick shout out to Momo. So covered calls are considered no risk. It depends on how you think about risk. A covered call gives someone else the right to take it away from you at a higher level. So in our case here, if we are, let's just pretend this was a new high and it closed at a new high, and we sell like an 850 covered call, right? On companies, I've actually, every time I sell covered calls on Shopify, it ends up getting taken away from me. So, it is what it is. But if I was to sell a covered call at the 850 strike, to sell a CC, what that means is I'm giving away all of this upside. If it goes higher, all this up here, I'm giving this away. I'm giving that to someone else. And for that, I collect premium, right? That's my trade. And I'm essentially, Jeremy calls it renting out your stock. Now, obviously, if it goes higher, someone else gets above 850. But something you could do is you could buy, if it goes above, you could buy another call option up here, and you get all the, maybe at 900 and get all the upside. That would be one way to kind of mitigate that. But again, because you're selling an option contract, you're selling option premium, you have an obligation. The person on the other end who's buying the call option, they have a option, right? They have rights. They don't have to, it's not a requirement, but you as the seller, you have obligations, right? Yep. If you took profit on put, would you likely load up on stock? Typically, I do not. I kind of let callers expire worthless. Obviously, if a put expires in the money, then I have to decide whether I want to exercise that. Typically, you would, of course. Yep. So the only risk is losing put money and possibility of stock going down. No. So the only risk is losing put money. So no. So you're not losing put money if you. Let me reset my chart here. So you're not losing. If I sell a strike, let's say I get, let's just say for easy math, I get $20 to sell a CC up here at 850. Okay. Mohammed at 850. Okay. And I'm collecting a positive $20 credit. So I'm selling it, I'm collecting a $20 credit. Okay. And then I'm going to turn around and buy for the same amount, roughly $20, I'm going to buy a put. Okay, so I'm protected against the downside. The price can go to zero, and I am protected right here at this level. Okay, now I'm giving up the upside of this wherever I sell my strike for my covered call. Okay, so you're not losing put money. you're collecting money, and then you're kind of selling this to finance the purchase of that, right? You're selling a covered call to finance put option buying. So technically you would say that your short calls, short and sell are interchangeable, long and buy are kind of interchangeable. So then you would be long puts. How do you know that you've missed the move? They go flat or second distribution phase. Yes. Again, Chris Maurice, if a stock like this has pulled away from its moving averages quite a bit, at some point they're going to retest. They always do. You may have to wait 6 months, a year, but you have to be willing to wait for that to happen. You do not want to chase the higher. Yep. The option broker can be different from the stock broker. Yes, that's right. Yep. Are those shares automatically transferred when called away? They absolutely are. So you wake up and let's say you have 300 shares and the call option expires. Let's see if I can get this to expire in the money up here. There we go. So let's say that the option is expired. It's now in the money and I have, let's say 300 shares. I wake up, 300 shares are gone, and the money for that is kind of like it becomes a realized gain. The cash is now in your account. Now you obviously, if your average was down here around the 370 level and you sold it up at 850, no one's going to cry for you that you made a nice chunk on your 300 shares. That's kind of how it works. And obviously you're selling a covered call at a strike price that you're okay with getting it taken away from you. Right. So even if the P&L for the calls and the puts are red, which they will be if it's taken away, right? Even if that happens, you're still, you still made a nice gain, right? Let's see. Joseph has raised his hand. You have a question. Oh, and Mike, I do not roll covered calls. I don't typically do that because I don't understand the purpose of rolling. You're selling and then buying again, right? So you call it selling and buying. You're jumping back in. So a lot of times people will roll options when they're negative, and I've seen there's been some really tremendous blowups of companies who are people who've been upside down on an option, roll it farther, it's a bigger loss, roll it some more, and it's bigger and bigger. Ideally, at least Jeremy and I, that's kind of our opinion here. So, okay, no problem. So the aim is to keep the shares and protect as they move higher until you're called away by either cover call or you sell at the put price. Exactly. Okay, that's exactly right. Do you have a rule to buy back the call if the price drops, or can you cover the put premium? Do I have a rule to buy back the call if the price drops? So once you've exited a pyramid, once you've exited the calls expiring the money and the shares are taken away from you, you can absolutely set up another pyramid. There's plenty of opportunities here on Shopify. Let's see, we're here in the summer right now, so we're July. Let's see what happens. Lots of opportunities. So you could say, I'm going to buy my first level here, my second level down here. It may or may not ever happen. It may just rocket higher, right? So you want to limit buy. My right click is not working. Why isn't it working? Oh, let's see what happens. See, I got it filled there, and it just goes higher. And if I didn't get filled there, I would got filled there, right? So there's lots of opportunities. In this case, you obviously need to kind of think about where you want to enter, and certainly getting in at the 100 and the 200, those are obvious, decent spots to do that in case you don't know where to draw your lines. Obviously, yep. So in case of color, you just let them expire. I'm not sure what you mean in case of color. What does that mean? In case of color. Okay, let me show you one more, and then we're going to bring on a guest to share his experience with this exact strategy. Let's look at Pinterest. You guys see where I set up my levels back through here on Pinterest. I'm going to buy 8,300, 83, and 16. And in my case, I got filled on the first leg, and it went higher. and I absolutely got called away. I think I had a 40 or 45 strike call option that I sold, and I sold it on this day right here on the second day up, gapped up over earnings. I think my average was around $20, $25, gapped up over earnings, sold it, got taken away, made a nice profit. No one's going to cry for me. Now, of course, it went higher, and then, you know, it's doing its thing now, but that's kind of how that works. Does everyone understand? Covered calls and puts, and you let them expire in the expiration date. You don't close them either. That's correct. Because the purpose of a collar is not really even to try to make money on it. You can certainly close it down early and take a loss on the collar. But the purpose of the collar is to kind of protect your gains, right? It's kind of like if you get, let's say you get a car, your first car, you turn 16 or 18 or whatever it is in your country. In the US, at 16, you get a car, a used car, and you get an insurance policy, and you figure out a way that the insurance can be like little to no cost. That's kind of what we're doing here. Now, if some of you guys never have a claim against your car insurance, you don't really see it as a loss, right? You don't see it as, oh, I wasted money, right? You don't really see it that way. You see it as, I had it in case I needed it. That's kind of the purpose, right? And that's kind of the idea, so that you can certainly do that. So Thomas is saying you could take a profit if it moves down. Yes, obviously, if you have a collar set up here, and let's say your covered call is here and your puts are here, and let's say it expires in the money here, right? Expires in money. You obviously, your collar will have a gain on it, and that's just because the difference between your strike and your kind of where it closed at expiration. So in that case, you have the option to you could sell. Let's see, you bought to open the put, so you can sell to close the put, make a little bit of money, which means it doesn't right before it expires. So it doesn't actually close in the money. You can certainly do that, make a little bit of money off that. Your covered call, obviously, that's going to be profitable if that's the scenario here. Yep. So you could certainly sell the puts for a gain and buy back the covered call. Yep, exactly. And you would buy back the covered call because you sold to open it, right? So to reverse that, you do the opposite. You would sell to open. Okay. What other questions you guys have for me? Great questions, gang. All right. So I'm going to bring on a guest, and let's see if he's here. Are you here? You're muted.
Can you hear me?
Yes. Hello, ladies and gentlemen. This is Yates.
What's up, team?
Yep. So this is Yates. He is a member of RLT for 3 years. Last month did 9.5 R, solid gains in October. And he will be hosting his own mentoring group starting at the beginning of the year. Welcome, Yates. How are you?
I'm doing excellent. Thanks for having me on.
Yeah. So share with us kind of some of your recent trades where you're position trading using collars. Walk us through some examples.
Yep. Let's pull up Roku to start.
Roku, one of my favorites. Okay. Roku.
And let's start back trading it at August 24th.
This year?
Yep.
Ooh, nice. Okay. Let's see. We're at August 21, August 24. There we go.
Yeah, perfect. So just play a couple candles. I did not get in during that terrific gap there. So play 3 more.
Okay.
So at this point, actually play 4 more. Sorry, it's hard to see. Yeah. Okay. At this point, yeah, right there. So I set up my pyramid at the top of there. So if you want to put lines at 169, and I set that one up due to the old support over there.
Okay.
And then 159 and 149.
Okay. So good numbers.
Exactly. And the reason I used those is the 169 number, and then I basically just went down $10 a share.
Yep.
And the 50 was right around that 149, so I figured that'd be perfect.
Okay.
And so you can play a
Switch
couple
to-
more.
Okay, yep, there's your 50 right there. Yep.
And the levels were 20 shares at the top, 30 shares at the middle, and 50 shares at the bottom.
Okay, 20. You like limit at 169. You said 20, 30, and 50.
20, 30, 50, correct.
So 30 limit buy at 159. Okay. And then 149.
And I set those up on September 2nd.
September 2nd. Okay, yep.
Yeah, right
Got
there.
it.
So I got filled on 2 right there.
Yeah, you missed that by some pennies.
So I was going for the gap fill there on the October 25th gap
Yep,
fill.
I got it. Yep.
It was off the 50 and it actually doesn't get filled. So I didn't get filled on that third leg of the pyramid. Nitro actually said something earlier in the chat that you're only getting filled on the top 2 legs recently. And that's definitely been true for me. I haven't gotten filled on my 4th leg in quite a while, several months at least.
Gotcha.
Just because things are so bullish recently. So
Yep.
you can just play it a little bit.
Play some candles.
Give me a couple candles.
Yeah. So, ladies and gentlemen, let's calculate something real quick. So, if Yates, I'm just going to calculate what is your cost basis. So the folks watching us can easily figure out where we are, what our average is. So 20 times 169 equals, and then 30 times 159 equals. So let me do the math real quick. 169 times 20 is 3380. And then double check the math for me, William. 159 times 30. Oops. Try it again. 159 times 30 is 1770. Okay. Yep. And
that one
divided by 50.
That one, the 159 one's off. 1770.
159 times 30 is, sorry, 4770. Yep, sorry. Okay, so then we'll take 4770 plus our 3380 and divide that by 50. So our average cost basis is right at 163. 163 average cost. Okay, so now we know. Now we know. And you guys can see here, obviously, the way he set this up, was expecting it to get filled. He has 3 legs, got filled on 2. 163 at this point. He's already profitable. We could put a little line out here for 163. We'll just say 163 average cost. Let's make it a little bit different color. 163. Okay, there we go.
Perfect.
Okay.
I do like putting an average cost on the screen because that way I know I'm always going to be selling my covered calls over that, hopefully.
All right. Yep. Yep.
So it is nice to have that line on the screen there and get that figured out for your chart.
Okay.
So yeah, just keep playing up till September 21st.
Ooh,
Yeah,
look
right
at
there.
Look at that.
That's a big, nice breakout candle too. If you look to the left of your chart, it just broke out through.
Got new high. Yep.
Pretty much everything. Yeah. So that was a really nice one. Since I wasn't in a full position, I could not sell a covered call. I couldn't really get into a caller. So what I did is I put a target at 200 for 20 of my shares.
Okay. I'm going to sell 20. Now, ladies and gentlemen, what Yates is talking about is because he only got filled on a partial, he only had 50 shares. Now, you will recall earlier we talked about you have to have at least 100 to sell a contract because one option contract represents 100 shares. And had he got filled down here, he would have been able to do a caller. And that happens sometimes on these higher price stocks. These higher growth stocks, they make their moves, right? So, okay, good.
Yep. So I just put a target there at 200 just for 20, and it got filled on that day. Right.
Oh yeah,
there.
almost the top. Look at that.
Yeah,
like a champ.
Well, just wait what happens next. So then after I got filled, I wanted to get in that 20 shares again, but lower than where I sold. So I set up a limit buy at 176.55.
Okay, so 176.55.
for that same 20 shares.
Oh, so you sold that 20, you want to buy back. I
Yep.
got you. Okay.
And the reason for that is back on the left of your chart, there's an exact high of 176.55. And you will see that I missed that by another couple of cents.
Let's see what happens. It's going higher
It's going higher.
until it doesn't. So you have an open limit buy order. Is that right?
Correct. Yep. Open limit buy order down there. I've canceled at this point. Yeah.
I got you. Yeah.
And I actually sold my other shares at the gap up there.
Right. Yep. One of these two. That's probably this one.
Back a little ways, just when it was just going straight up, it felt like around the October 8th. So I got out of the whole position around there.
Okay, on that gap right there. I got it.
Yep.
Got it. So 50 shares. And he tried to pyramid in, it just didn't cooperate. He couldn't put a collar on because he had 50 shares and not the 100 minimum. Obviously, when you use when you try to pyramid in, obviously the idea would be increments of that 100. So 100, 200, 300. In his case, he didn't get filled and missed it by pennies, literally. So the low of that Yates was 150.38, and you wanted it one. So $1.38.
Yeah.
$1.38, and you missed out on
a big run.
So what was that total? A couple of R's? What was your
yeah, it was a couple $1,000s. Like sometimes R's are a little bit hard to figure out when you're doing position trading. Just because it's a little bit arbitrary, but yep.
Gotcha. Cool. Excellent. Thank you for sharing. Do you have another example you want to see?
Yeah, we could look at MU, where I did a collar on that one.
Okay.
So let's start the back trading at August 7th of this year.
Okay. August 6th, August 7th.
So I set up my first 100 at 48.
So you're gonna see limit buy 100 at $48, right?
Yep.
Okay.
I set up my second 100 at 44.64.
Your second 100 or
this one I did just 100 on both of these. And then I had a trend line. I was wanting to get into another 300, kind of down around the 40 area.
You said 44.6. Tell me again.
44.64.
Okay. Yeah.
Yep. Perfect.
Yep.
So those were my only two limit buys, and then I did sell some puts that, as we play through, I can tell you when I did that. So
okay.
Give me 3 candles.
1, 2, 3.
Okay. Yep. So I was filled on that first 100 at 48.
Yep.
And then give me one more candle.
Boom.
So we had a nice gap down. I'm red on that position, but I decided to sell a $42.50 put for the coming September.
Okay.
And
so
I sold 3 of those.
Okay. Uh, 42.50. So he's actually combining a couple strategies here, ladies and gentlemen. Selling 3 put September. What was it? September like the 18th?
20th, I think, actually. Or the 20th.
Yeah, there we go. 42.50. Okay, ready for some more candles?
Yes, and just so someone was asking in the chat pane earlier about selling puts to leg into positions, and I was kind of talking to them in the chat, and we will see why that's not always the best idea here, to just sell puts for it. So give me, I think, 4 more candles. 3.
Oh, it depends. Let's see, September. Let me move this to September 18th too. So let's see. Oops. It may not have been, depending on how I guess it closed. Obviously, that was the expiration. You still wouldn't again. You would have been close, but still not been put to shares.
Yep. So we did bounce there.
Yeah.
I did not get put those shares, so I was still just in the 200. If I did just have a limit buy there, I would have gotten into another 300
Oh, yeah.
shares, and I
Yep.
would have been in my whole position. So that is a risk of just trying to sell puts in
Makes
one of
sense.
the bottom portions, for sure. So
Makes sense. Yep.
I was just in two for now. Give me a couple more candles there.
Okay.
A few more. And yeah, actually, there's a gap up here. Yeah, so give me a few more after that one, like 5 more, I think.
Okay.
So right, the next candle, next one. Sorry.
The next one.
So that's the one. I got a caller because earnings were coming up, so I wanted to be in a caller over earnings. So I
Hopefully,
got
like up at this high part of the candle. Hopefully.
Yep, somewhere in there. I got into pretty much around the open actually. So yeah, probably around $51. I
Yep.
got into a $53. I sold a $53 covered call, and I bought the 47 put.
Sell the 43 covered call.
Sold a 53 covered call.
I'm sorry. I'm looking at the numbers and I said around 53 covered call, and you bought the
47.
Yep. Okay. Oh, that is a terror. I might as well just use the lines that I'm given, right? 47. Okay. And what was it, roughly the same premium?
It was, yeah, right about the same premium on that. I had a credit, but it was just a few cents.
Same expiration, I assume.
Same expiration, and I actually sold on that one. I think I did October. I did the October monthly.
Okay, so sell 53 covered call the October, which would have been the 16th.
Yep, 16th.
Okay, there we go. Very good.
Yeah, to answer NK, I always get in callers over earnings. Some stocks I actually will just get in protected puts actually, if I think it's in a spot where it could run and I'd get called away where I don't want to. But I'm always in at least some form of puts. I could be in a partial, some kind of dynamic collar, but I will be in some kind of protection over earnings.
And then in this case, your average cost is 46.32, right?
Yep.
Yep. So nice.
Right in there.
So your put is, you're guaranteed no matter what, your put is a little bit of, you're going to get put, you're going to kind of a profit locked in. So yeah, cool. So play some more candles, or where do we go?
Yes, play a couple more candles. Yep. We'll see. A few more. Yeah, so right there, stop. Yep. I actually exited that collar for a profit there because we gapped down. I decided it was coming close to filling that gap. So I think I still just about broke even on that put, even though you are lower, but just because the time decay on it. So I pretty much broke even on the put, sold the call for a small win. And so I was just out of my protection at that point.
Okay. And then you still had your 200 shares then?
Yep, still just in 200 shares. And actually, yeah, so I actually sold on that day as well. When I exited that collar, I sold 3 more put sales down at 40 to see if we did keep running down.
On this low, these lows. Yep. Cool.
3 more at 40 for not too much premium, but that was where my third leg was going to be. And we can see it just kind of ran from there. And I exited right around there, right around before, right up in there somewhere, because it was just that old resistance.
Kind of a holder. Yeah, nice. You guys can see kind of the level he's talking about through here. Yep. Cool. Well, thank you so much.
Yep, absolutely. And I did just one other thing that I like to do. People were talking about what if it keeps going down, and what if you get in your stock and it keeps going down and down. If I have my portfolio that I'm looking at as a whole, I don't like to get into all of my legs. If I'm filled on all my legs on every position I'm trying to get into, I don't like that to be my entire portfolio. I'll leave some for position trading. I mean, obviously it's not my whole portfolio anyway, but I'll leave some position trading part left over. So if we do go down, I can get into some. It's in my plan to get in some lower when you see some more bottoming signals, so that on the way up you are making some money and you're not just hoping to break even at some point.
Right. Cool. Cool. Well, thank you so much for sharing. Ladies and gentlemen, let's give Yates a virtual round of applause.
Thanks, everybody. Thanks for having me, Matt.
Thanks. All right, ladies and gentlemen, a couple more slides and we will be done. So number one, be mindful, that you do need at least 100 shares for a covered call, right? We talked about that. In Yates' first example, he only had 50 shares. He tried to get 100, but it just didn't work out. Next is don't be in a hurry to add a caller. For those of you who know, when you reach highs and you sell kind of an out of the money covered call, as the stock price approaches that, this position will be red and your shares will be taken away from you. So don't be in a hurry to add a caller. Okay. And then obviously selling the limits your upside. So if you sell at a certain strike, anything above there, you are giving the rights away to whoever bought the call option from you. And I use 30 to 60 days if you feel like it's going to consolidate for a little while. Let's see. And then next, that's all I have for you. Do you guys have any questions for me? Now, while you're putting your questions in this chat pane, I want you guys to think about, what is your why? What is your reason for wanting to do this? A lot of people join RLT to make extra income while working a full-time job. The most impactful, powerful why that I've heard came from a woman who's still in our community to this day. She said the reason she wants to learn to trade stocks is to break the curse of poverty on her family tree, to provide for her kids and grandkids. Ladies and gentlemen, that is a very, very strong why. And if someone is having a hard day, a bad day, right, things aren't working out, that is enough motivation to keep pushing through. Making extra income, right? Maybe, maybe not. Maybe you give up. Maybe it's too hard. Maybe, right? But I want you guys to think about something that's super impactful. Now, our why, Real Life Trading, all of our team members, our why is to enrich lives. That's what we're here for. So let's get into your questions. Let's see. Copy of the slides. Yes, I can publish those in the Slack channel. For those of you who are Real Life Trading members, I can post that as soon as we're done. Yep, absolutely. Any other questions for me, ladies and gentlemen? All right, put some dollar signs in the chat pane if you learned something tonight, something that was valuable, something that was worthwhile, something you can implement fairly quickly, fairly immediately. This again was our position trading class. We learned to build pyramids and kind of protect our gains as stocks went higher. Yep. Yes. All right, cool. Looks like a few people learned a few things. Yep. So the question is there more topics today or just questions? That is the end of the class today. I will stick around for some more questions. This is being recorded, so we will email this out later for those of you who weren't able to make it live. Yep. Obviously, you guys are live. Yep. Thank you, guys. Thank you. Yep. Any other final questions? All right, ladies and gentlemen, I am about to lace up my running shoes and I'm about to run 4 miles every 4 hours for the next 48 hours, starting here at the top of the next hour. So in case you guys are getting to sleep in on a Saturday, I'll be getting up at midnight. So set your alarms if you want to run with me. I'll be getting up at 4 a.m., 8 a.m., midnight, going around the clock, right? Noon, sorry. 4 a.m., 8 a.m., noon, 4 p.m., 8 p.m., noon. I'm sorry, 4 p.m., 8 p.m., midnight, and then repeating it 2 days straight. I'll be running 48 miles. I'm doing the 4x4x48 challenge. But ladies and gentlemen, thank you so much. Thank you so much for joining us tonight. And don't forget to love life, live life, and trade it. Thank you guys. You rock. Have an amazing weekend.